Money panic always created the same human instinct: protect what is yours before the system changes the rules. During the Great Depression, the rules changed fast. If old-school American money survival stories were your thing, consider subscribing so you never miss a video like this, because these were 25 Great Depression money tricks the government made illegal to use today. Number 25. Hoarding gold coins at home. Forbidding the hoarding of gold coin. That was the headline Americans woke up to on April 5th, 1933, when FDR signed Executive Order 6102. Not a suggestion, an order. Turn it in by May 1st, 1933. Treasury, the Federal Reserve, and local banks became the collection funnel, and the penalty for refusing was brutal: a fine up to $10,000, up to 10 years in prison, or both. Short deadline, huge threat. This was not about rare coins in a display case. It targeted ordinary gold savings, the kind tucked into a tin, a sock drawer, or a coffee can in the pantry. Quiet money became contraband. Number 24. Selling unregistered securities to neighbors. In Washington, the crash was treated like a crime scene, and Congress responded the way governments always did after a disaster, by tightening the paperwork. The Securities Act of 1933, enacted on May 27, 1933, put a new lock on a very old habit. In the 1920s, investments were often sold the same way farm equipment was sold, neighbor to neighbor, on trust. During the Depression, that informal dealing still happened because banks were broken and people were desperate for any edge. Then, the federal government drew a bright line: sell securities to the public without proper registration, and the law treated it as an unlawful offer or sale. That shift created the modern world of prospectuses, disclosures, and regulators like the SEC, and it made the handshake stock deal a legal minefield. Number 23. Issuing your own emergency town currency, scrip. Stamp scrip looked like money, spent like money, and in plenty of towns it became money because regular cash had vanished. A local board, a relief office, or a chamber of commerce printed notes, and people kept trade alive, one grocery bag at a time. Then came the catch. To keep the scrip alive, it often required stamps on the back, commonly a 2-cent stamp each week, so the paper kept circulating instead of getting hoarded. Families learned the rhythm fast: spend it, stamp it, move it. Once the banking system stabilized after March 1933, anything that acted too much like a private currency drew official hostility. Local money still existed today in gentler forms, but the closer it got to functioning as real currency, the tighter the legal risk became. Number 22. Joining a bank clearinghouse certificate network. At 1 in the morning on Monday, March 6, 1933, the U.S. entered a week where banking basically stopped. Proclamation 2039 froze withdrawals, loans, and even foreign exchange because officials feared hoarding and panic more than inconvenience. Before that freeze, banks had a private sector emergency tool: clearinghouse certificates. In earlier panics, bank associations issued temporary paper backed by pooled assets, a way to settle debts and keep commerce breathing when currency ran short. It was ugly, but it worked. After the bank holiday era, that kind of improvised quasi-money workaround stopped being something the public sector tolerated. Banks are not free to invent money substitutes that circulate like currency, and anything that tries can run straight into regulators. Number 21. Running a business below the NRA. Minimum prices. Before the New Deal, low prices were a survival tactic. After the National Industrial Recovery Act created the National Recovery Administration in 1933, low prices could be treated like sabotage. The NRA was built to end what officials called cutthroat competition. Businesses were pressured into codes of fair practice that set minimum wages, maximum hours, and also minimum prices. That meant a shopkeeper trying to undercut competitors to keep the lights on could suddenly be out of compliance, not with a private agreement, but with a government-backed system. The irony was sharp. Customers needed bargains, families needed work, and many small operators needed volume. Yet the rulebook tried to freeze the market into fair behavior, and it turned a classic Depression-era tactic, sell cheaper to survive, into a punishable violation. Number 20. Keeping a personal gold bullion stockpile. In the winter of 1933, the most stubborn savers learned a hard lesson. The government could set the price, set the deadline, and set the penalty. $20.67 per troy ounce was the official exchange rate Americans were paid when they surrendered gold under Executive Order 6102. Then the punchline landed. On January 30th, 1934, the Gold Reserve Act rewrote the rules, and immediately after, the official price was set at $35 an ounce. Same metal, new number, bigger gap. That gap mattered because it told ordinary people what the new order was. Gold was not just a personal hedge. And Treasury and Congress had decided gold belonged inside the system, not under your floorboards. Private bullion hoards, once the ultimate rainy day plan, became the wrong kind of independence. Number 19. Hiding cash in a family barter network. At 12 years old, plenty of kids during the Depression learned the same adult rule. Cash disappeared first. So families built networks, potatoes for a haircut, sewing for firewood, carpentry for eggs. No bank, no credit card, just trust, labor, and a ledger in somebody's kitchen. Barter felt clean because it felt local. It also felt invisible, especially when the deal never touched a paycheck or a receipt. In an era of rising pressure on revenue, officials hated invisible economies, and modern tax law makes the principle blunt. Barter counts as income at fair market value. So that old survival trick, keep value moving without money, still existed today. The illegal part was pretending the swap never happened, and that was a mistake many Depression-era households made on purpose. Drop a comment and let us know where you're watching from, city and state, or just the country. These old money habits changed a lot depending on where a family lived, a farm county, a mill town, or a big city block. Number 18. Employing children under 14 as paid workers. In 1930s America, poverty did not wait for adulthood. Children worked because rent worked, hunger worked, and debt worked. In mill towns, farm counties, and city streets, a paid child was often the difference between groceries and nothing, even when the job was dangerous, exhausting, and plainly unfair. The federal government eventually drew a line with the Fair Labor Standards Act of 1938. It banned oppressive child labor, set a minimum wage of 25 cents an hour, and set a maximum work week at 44 hours in covered industries. That law changed the household math. It also changed the moral math. A practice families treated as grim necessity became a regulated, enforceable violation, and it is still one of the clearest examples of the Depression turning private survival choices into national labor policy. Number 17. Printing and circulating business. Specific scrip for payroll. The moment payroll came due in March 1933, some employers had a choice between improvisation and collapse. Banks were closed, cash was scarce, and workers still needed to eat. So, a number of businesses paid employees with company-issued checks or scrip meant to circulate locally, accepted at certain stores, and redeemed later. In practice, it created a mini economy. Employers, workers, and shopkeepers all became part of the same fragile promise. This paper would be honored when the doors reopened. It was not counterfeit, but it walked like money in a world starving for money. Today, gift cards and store credit are one thing, but wages covered by federal wage rules must be paid in cash or a negotiable instrument payable at par, not in scrip, tokens, or coupons. And if you issue tiny notes under $1 meant to circulate as money, federal law calls that out too. Number 16. Operating an unlicensed private loan business. Regulators learned something brutal during the banking collapse. When formal credit disappeared, informal credit rushed in. Loans moved from institutions to individuals, from bank lobbies to back porches, from paperwork to pressure. A neighbor with cash could become the neighborhood bank. Some were kind, some were ruthless. Interest rates climbed, repayment terms got uglier, and families who missed a week of wages could get trapped fast. Private lending itself can be legal. The trap is turning it into a business, marketing it to the public, or charging rates that cross state usury lines. What looked like a simple handshake loan in 1932 can become a regulated, punishable product in the modern system. Number 15. Selling homemade liquor. Moonshining. At its peak, bootlegging was not a hobby, it was an industry, and the Depression made it more tempting than ever. Even after Prohibition ended with the 21st Amendment on December 5, 1933, the urge to turn grain into cash never disappeared. A still in a shed could do what a closed factory could not. It could produce something people would trade for, quietly and quickly. Rural families, laid-off workers, and organized crews all played versions of the same game. Make liquor, move it, avoid tax. The law never stopped caring about the tax. Today, distilling spirits at home without the right federal permit remains a crime. The modern regulator is the Alcohol and Tobacco Tax and Trade Bureau, and the Depression-era logic still applies. The government wants its cut, and it wants control. Number 14. Forming an unauthorized private bank. More than 9,000 bank failures. That is what the United States lived through between 1930 and 1933. A wave so violent it rewired public trust for generations. When official banks failed, people went looking for anything that acted like a bank, a business that held money, a club that protected deposits, a person who managed savings. That opened the door to unauthorized banking schemes. Some were honest community pools. Others were disasters waiting to happen. The New Deal response was sweeping. Federal examinations, new rules, and the rise of deposit insurance through the FDIC. Today, taking deposits from the public without a charter is not a folk solution. It is a serious legal problem. What looked like neighborly safety in 1932 can look like illegal banking in 2026, depending on how it is structured and advertised. Number 13. Using gold clause contracts to guarantee payment value. Against public policy, that was the government's verdict on one of the smartest legal shields wealthy Americans had. On June 5, 1933, Congress passed a joint resolution that voided gold clauses in contracts, provisions that required repayment in gold or in dollars measured by gold. Gold clauses were not flashy. They were elegant. In a world where paper could be devalued, a gold clause was a promise that the lender would not get repaid in cheaper money. It protected bondholders, landlords, and long-term creditors. Then the government said no. The issue reached the Supreme Court in the 1935 Gold Clause cases, including Norman versus Baltimore and Ohio Railroad, and the New Deal position largely held. The modern lesson is blunt. When currency policy shifts, private contracts do not always get to opt out. Number 12. Selling farm produce at market-set prices, ignoring AAA controls. By 1933, farm prices were so crushed that more production often meant more loss. The Agricultural Adjustment Act and its AAA program tried to raise prices by paying farmers to reduce output and by building a system of quotas and controls. That collided with an older American instinct: plant, harvest, sell, and keep whatever profit you could claw out. Under the new system, producing beyond limits could bring penalties, and the federal government was willing to police even deeply local decisions. The long shadow showed up later in cases like Wickard versus Filburn, where a farmer was penalized for producing wheat beyond his allotment under the Agricultural Adjustment Act of 1938. The Depression-era point still mattered. Once farm policy became national economic policy, my land, my crop, stopped being the whole argument. Number 11. Pooling neighborhood savings outside a licensed bank. The night a local bank closed, a town learned who had real cash and who only had numbers in a passbook. So neighbors started pooling. A few dollars per family, kept in a tin, rotated out for emergencies, sometimes lent to a member who needed rent money. It felt safer than a bank. It felt personal. It also created a quiet promise: bring your savings here, not there. A small private savings circle can be one thing, but once something starts taking deposits from the public, advertising itself, or acting like a bank, the legal line shows up fast. The Depression made these pools understandable. The modern system makes bank-like behavior heavily restricted. Number 10. Running an off-the-books cash business to avoid income tax. The organization that frightened a lot of hidden earners was not a gang. It was the Internal Revenue Service. In the Depression, cash-only side businesses were everywhere: street vending, odd repairs, house painting, poker nights, and just a little trade in the shadows. The government proved it could punish the shadows. Al Capone was convicted of income tax evasion on October 17, 1931, and spent the decade behind bars, and the symbolism was louder than the man. A person could dodge police for years and still get caught on paper. Then taxes rose. The Revenue Act of 1932 pushed the top marginal income tax rate from 25% to 63%. Hiding income felt tempting. It also became, unmistakably, a felony-shaped trap. Number 9. Buying and reselling price-controlled goods. Black market trading. Before the New Deal codes, a bargain was a bargain. After the National Recovery Administration, a bargain could look like a violation. When rules set minimum prices and forced fair practices onto industries, they also created the oldest economic creature on Earth, the black market. A middleman could buy low, sell under the mandated price, and move inventory fast. Families did it for survival. Hustlers did it for profit. Either way, it undercut the government's plan. The legal drama peaked in Schechter Poultry Corporation versus United States, decided on May 27, 1935, when the Supreme Court struck down the National Industrial Recovery Act framework. For a brief Depression-era window, though, the government tried to criminalize price chaos, and plenty of Americans treated that as an invitation to trade around the rules. Of these, so far, the gold rules usually hit hardest in family stories. Share the one that sounded most familiar in your own family history, especially if it involved gold, cash, a bank run, or a paycheck that suddenly became paper. Number 8. Refusing to report bartered income on tax returns. The practice that redefined countless kitchens and backyards was barter. A repair for a sack of flour, a day of farm labor for a share of vegetables, a seamstress trading work for coal. It was community economics, and it kept people alive. But tax law did not vanish just because cash vanished. Even when money never changed hands, value did. And the federal position has long been that bartered goods and services count as taxable income at fair market value. That meant the Depression-era trick, trade, instead of getting paid, was not the illegal part. The illegal part was pretending the value was zero. Modern IRS guidance still treats barter this way, and formal barter exchanges even issue reporting forms. What looked like a neighborly swap in 1932 can still become a reporting problem in 2026 if it is done at scale and left off the return. Number 7. Operating a private currency exchange between neighbors. In March 1933, the government did not just close banks. Proclamation 2039 also froze foreign exchange transactions because officials feared money fleeing the country and panic becoming permanent. Currency itself became a controlled substance for a week. That atmosphere shaped how authorities viewed private exchanging and dealing. In hard times, people tried to hedge by holding different kinds of money: foreign currency, gold-linked paper, silver certificates, anything that felt safer than a bank deposit. Trading it quietly between neighbors felt harmless. Today, casually swapping bills with a friend is one thing. Running currency exchange or money transmission as a business is another. Do it at scale, take fees, or operate without the right registration, and you can collide with modern financial crime rules fast. Number 6. Selling securities door-to-door without a license. The rebuild of Wall Street was not just about confidence, it was about control. After 1933 and 1934, the U.S. created a securities system where brokers, dealers, and public offerings lived inside a registration and disclosure machine. That mattered because the Depression era had plenty of informal salesmen, traveling promoters, and trusted community figures who sold investments like they sold encyclopedias. The modern world treats that as a regulated profession. Selling securities without the right registration can trigger enforcement, civil lawsuits, and criminal penalties, and groups like the SEC and FINRA sit at the center of that oversight. The human story stayed the same. A neighbor promised a safe return. A family wanted to believe. After the New Deal laws, belief was not enough. The paperwork became the product. Number 5. Holding foreign gold coins as a currency reserve. The night everything changed, plenty of savers looked for loopholes. If American gold was being targeted, maybe foreign gold felt safer. British sovereigns, Mexican pesos, French coins, anything that looked like it belonged to another world. Executive Order 6102 did not care. It required delivery of gold coin, gold bullion, and gold certificates held within the continental United States, with only narrow exceptions like small amounts and certain collector pieces. Foreign gold sitting in an American kitchen was still gold sitting in America. That is why the foreign coin stash became one of those whispered family stories. The stash that got turned in, the stash that got hidden deeper, the stash that disappeared before anyone could ask. Today, private ownership of gold is legal, but cute loopholes have a long history of ending badly. Number 4. Working more than the NRA. Maximum hours for extra pay. The organization that tried to regulate time itself was the National Recovery Administration. Under its codes, maximum weekly hours were set for many industries, and employers who violated the code risked penalties and public pressure. The idea was simple: spread work around, lift wages, stabilize competition. For a worker, the reality could feel absurd. A willing employee could want extra hours, and a struggling shop could want extra labor, but the code treated too much work as part of the problem. It was government-guided scarcity, applied to time. The NRA was dissolved after the Supreme Court decision in Schechter Poultry Corporation versus United States on May 27, 1935. But the Depression-era impulse did not disappear. Modern labor law still regulates hours through overtime rules, child labor limits, and record-keeping requirements. The old free-for-all is gone. Number 3. Using a personal gold certificate as payment. 3 dates mattered. March 6, 1933, the Bank Holiday Proclamation. March 10, 1933, Executive Order 6073, laying out emergency bank operating rules. April 5, 1933, Executive Order 6102. Gold certificates were paper claims connected to gold. People trusted them because they represented something tangible, and in a panic, tangibility is a drug. But the government viewed them as a pipeline out of the system, and Executive Order 6102 directly required people to turn in gold certificates, with narrow exceptions. Restrictions later loosened for collectors. In April 1964, Treasury changed the rules to let the public hold gold certificates legally as collectibles. Today, they are not redeemable for gold. They are history you can spend at face value or collect for far more. Number 2, refusing to surrender inherited gold to the government. Deliver on or before May 1st, 1933. That was the command, and it applied to individuals, partnerships, associations, and corporations. Not just speculators, not just bankers, ordinary families. Inherited gold had a different emotional weight. A jar of coins was not an investment strategy, it was a family story, a wedding gift, a grandparent's insurance policy, a small private monument to hard work. Then the government treated it like a threat. The exemptions were narrow, including small amounts up to $100 in gold coin and certain rare collector pieces. For most households, the choice was simple and brutal. Turn it in for paper at $20.67 an ounce, or risk a $10,000 fine and up to 10 years in prison. Some families complied, some hid it deeper. That choice still echoes. Number 1. Owning more than $100 worth of gold, period. Before the crash, gold felt like common sense savings. After April 1933, owning too much gold became a legal risk, and the old instinct, store wealth in metal, got replaced with the new rule, store wealth where the system can see it. For decades, that ban shaped behavior. It pushed Americans toward bank deposits, bonds, and paper assets, and it trained families to treat gold like something for vaults, not sock drawers. The reversal did not fully arrive until the mid-1970s. On December 31st, 1974, Executive Order 11825 became effective and revoked executive orders, regulating private gold transactions, aligning with the return of legal private gold ownership. The warm part of the story is this. Even after laws, panics, and paper reshuffles, Americans kept the deeper habit, preparing for the hard season. They just had to do it with different tools.